Download this code from codegive.com, link in the description below. OK, let's delve into negative gearing, capital gains tax, CGT, and their interplay, especially in the context of Australian property investment. Since you didn't specify a country, I'll assume Australia, as it's a common area of discussion regarding these topics. This will be a detailed explanation, complete with code examples, using Python for calculations and considerations. Disclaimer ****, I am an AI chatbot and not a financial advisor. This information is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. 1. What is negative gearing? Negative gearing is an investment strategy where the expenses associated with an investment property, or other assets, exceed the income it generates during a financial year. In simpler terms, you're losing money on paper from the investment each year. The intention is to offset this loss against your other taxable income, like your salary, thereby reducing your overall tax liability in the short term. The expectation is that the capital appreciation, increase in the property's value, over time will outweigh the initial losses and ultimately provide a profit when the property is sold. Key components of negative gearing ****. Rental income ****, the rent you receive from tenants. Expenses ***, costs associated with owning and managing the property. These include interest on the mortgage ***, the most significant expense in most cases. Property management fees ***, fees paid to a property manager to handle tenant relations, maintenance, etc. Rates, council and water local government charges. Land tax state-based tax on land ownership, usually only if you own multiple properties. Insurance building, contents, and landlord insurance. Repairs and maintenance costs of fixing and maintaining the property. Depreciation a non-cash deduction representing the decline in value of the building and its assets over time. Other expenses strata fees, if applicable, advertising for tenants, legal fees, etc. How negative gearing works, in principle. 1. You buy an investment property. 2. The annual expenses, including mortgage interest, exceed the annual rental income. This creates a loss. 3. You deduct this loss from your taxable income, example your salary. 4. This reduces your overall taxable income, and therefore your tax liability. 5. You hope that the property's value increases over time, so when you sell it, you make a capital gain that offsets the accumulated losses and provides a profit. 2. What is capital gains tax, CGT? Capital gains tax, CGT, is a tax levied on the profit you make when you sell an asset, example property, shares, for more than you originally paid for it. It's not a separate tax, it's part of your income tax. The capital gain is added to your other taxable income in the year you sell the asset. Key concepts of CGT ***. Capital asset * the asset you're selling, example investment property. Cost base * the original purchase price of the asset, plus certain allowable expenses, example stamp duty, legal fees related to the purchase, costs of improvements. This is what you paid for the asset, in total. Capital proceeds * the amount you receive when you sell the asset, sale price, minus any selling expenses like real estate agent commissions and legal fees. Capital gain * capital proceeds, cost base. This is the profit you've made. CGT discount * in Australia, if you hold a capital asset for more than 12 months, you may be eligible for a CGT discount. For individuals, the discount is 50%. This means you only pay tax on 50% of the capital gain. For companies, there is no CGT discount. CGT event the event that triggers CGT, example selling the property. 3. The interplay of negative gearing and CGT. Here's where it gets interesting. Negative gearing and CGT are two sides of the same coin in property investment. You're strategically accepting short-term losses, through negative gearing, with the expectation of a larger capital gain, subject to CGT, in the future. Negative gearing reduces your taxable income now. This provides immediate tax relief. CGT applies when you sell. This is the tax you pay on the eventual profit. The key to successful negative gearing is to ensure that the capital gain you make, after CGT, outweighs the total accumulated losses from negative gearing over the holding period. It's a balancing act and involves careful planning. 4. Code examples, Python. Let's create a simplified Python example to illustrate the calculations. Keep in mind that this is a simplified model and doesn't account for all possible real-world complexities. Explanation of the code. 1. Calculate property investment, function takes key parameters as input: purchase price, annual rent, annual expenses, sale price, holding period, and your marginal tax rate. Calculates the annual loss or profit by subtracting annual expenses from annual rent. Calculates the annual tax benefit based on the marginal tax rate and the amount of the annual loss. Calculates the capital gain by subtracting the cost base from the sale price. Applies the CGT discount, 50% if held for more than 12 months. Calculates the CGT payable by multiplying the discounted capital gain by the marginal tax rate. Calculates the total profit by considering the capital gain, minus CGT, and the total annual tax benefits from negative gearing. 2. Example usage. Sets example values for the input parameters. Change these to reflect your specific situation. Calls the calculate property investment function with the example values. Prints the results. Important considerations and limitations of the code. Simplified model. This is a very simplified model. It doesn't account for inflation. The real value of money changes over time. A more sophisticated model would use discounted cash flow analysis to account for inflation. Changes in rent. Rent may increase, or decrease, over time. Changes in expenses. Mortgage interest rates, property management fees, rates, etc., can change. Depreciation. The code doesn't explicitly include depreciation as an expense. Depreciation can significantly impact the tax benefits of negative gearing. A depreciation schedule from a quantity surveyor is essential. Stamp duty and other purchase costs. The cost base only includes the purchase price. You should include stamp duty, legal fees, and other purchase costs to get a more accurate calculation. Selling costs. The capital proceeds do not deduct selling costs. You must include these expenses. Tax brackets. Marginal tax rates are tiered. The code assumes a single marginal tax rate for simplicity. Personal circumstances. Your personal financial situation and tax circumstances are unique. Depreciation. Depreciation is a crucial aspect of negative gearing in property investment. It's a non-cash deduction, meaning you don't actually spend the money, but you can still claim it as a tax deduction. A quantity surveyor prepares a depreciation schedule that outlines the depreciation allowances for the building, capital works, and its assets, plant and equipment. Vacancy periods. The code assumes the property is rented out for the entire year. Vacancy periods, when the property is vacant, will reduce rental income and therefore the tax benefits. Renovations and improvements. Renovations and improvements can increase the cost base of the property, which can reduce the capital gain when you sell it. They also impact depreciation. Borrowing costs. Loan establishment fees can be added to the cost base. Interest rate fluctuations. Interest rates can fluctuate, making a significant impact on expenses. 5. The importance of professional advice. Negative gearing and CGT can be complex. It's essential to seek professional advice from a qualified financial advisor to help you develop an investment strategy that aligns with your financial goals and risk tolerance. Tax accountant to ensure you understand the tax implications of negative gearing and CGT and that you're claiming all eligible deductions. Property investment advisor to help you identify suitable investment properties. Mortgage broker to help you find the best mortgage rates and terms. Quantity surveyor to provide a depreciation schedule for your investment property. 6. Is negative gearing a good strategy? Negative gearing is not a guaranteed path to wealth. It's a strategy that carries risks. Whether it's a good strategy for you depends on your financial situation. Do you have sufficient income to cover the initial losses and any unexpected expenses? Risk tolerance. Are you comfortable with the risks associated with property investment, example property value decline, interest rate increases, vacancy periods? Investment goals. Are you looking for long-term capital growth, or do you need immediate income? Tax bracket. The higher your marginal tax rate, the greater the tax benefits of negative gearing. Property selection. The potential for capital growth depends heavily on the location and type of property you choose. Alternatives to negative gearing. Positive gearing. Where the rental income exceeds the expenses. This generates income from the start, but the taxable income is higher. Neutral gearing. Where the rental income and expenses are roughly equal. Other investments. Shares, bonds, managed funds, etc. 7. Key takeaways. Negative gearing is an investment strategy where expenses exceed income, creating a short-term tax benefit. CGT is a tax on the profit you make when you sell an asset. The two are linked. Negative gearing relies on capital gains to outweigh accumulated losses. This Python code provides a simplified model, but professional advice is crucial for real-world decisions. Consider your financial situation, risk tolerance, and investment goals before pursuing negative gearing. In summary, negative gearing and CGT are complex aspects of property investment. By understanding the principles and seeking professional advice, you can make informed decisions that align with your financial goals. Remember that the code provided here is a simplified illustration and should not be used for making investment decisions without consulting qualified professionals. Good luck.